what it's taking its signals from, and why it's such a really excellent trade to take. And I'm going to give you all the metrics that we've acquired from doing 2 years of market replay data, running it forward at 500 speed, and determining all the metrics on the trade. Now, I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University. I've been involved in the financial markets for over 20 years. And I began trading the futures and Forex markets about 10 years ago. And my background really is in the optimization of mathematical models. When I was doing my graduate work at Penn, I wrote my thesis on the optimization of underwater decompression schedules using a Navy-generated optimization program called ASOP, which is an Automated Engineering and Scientific Optimization Program. And back in those days, doing a very deep dive for the Navy, coming up was a very complex process. You had to stop at different depths, wait for a certain period of time. You had to change oxygen mixtures. There was always an exchange of inert gas, and it was a very laborious and dangerous process. And back in the old days, when I was training, Penn really had the only computer in the world, and it used punch cards. So optimization of multivariable equations was really a new science, and its application by the Navy in this specific area was really sort of groundbreaking. So what I found was that complex physiological variables can be broken down into a multivariable equation, and if that's the case, so can the movement of any financial instrument in the markets. I mean, what we're doing essentially is looking at a closed system that's governed by specific independent variables. If those can be determined and placed in a multivariable equation, then the multivariable equation can be optimized. And that's what really gave birth to RightLineTrading, and really that's our mandate. One is to determine exactly what the independent variables that govern the movement of price in any financial instrument are, and then after we determine those independent variables, place them in an equation and look to optimize it to provide the equation that we provide in the form of software with a really significant predictive value of determining future price movement. Now, I'm going to talk about the transition zone trade, and it really is the best setup that we have, and it's the most profitable trade. Now, in going over 2 years of market replay data, approximately 80 to 85% of the trades are winners. Now, looking at crude oil, the average loser was $110, and the average winner was $280. So the risk to reward on the trade is approximately 1 to 3. For every dollar you risk, you seek to make 3 on average. And that is a really incredibly advantageous risk to reward. Now, if you leverage the risk to reward with the fact that 80% of the trades or better are going to be winners, you create an outstanding positive equity curve. And really, what the trade does is seek to leverage the direction of institutional money. You can easily make $500 on a trade, and I'm going to show you these setups on days and days and days of the market on real charts, not just on JPEGs that I photograph and show you. Now, a lot of software tells you that they can determine when institutional participation is occurring. And it's a very difficult thing to do. It isn't easy. And I really don't think that there are many software programs out there that can do it although many claim the ability to. And I'm going to show you exactly how we do it. Now, here's the thing, and I don't want to get too, listen, we're out to make money, and we're not too interested in the theoretical. We're interested in the practical. I mean, how do we apply what we know to the market to give us successful trades? At the end of the day, that's all that matters. But I really want you to look at the movement of price in a financial instrument this way. And if you have the correct mindset, I think, it really goes a long way into helping you get a successful trade. And remember that, I mean, I don't want to get, again, overly theoretical and turn off a lot of people, and a lot of people just close up and say, this is nuts. But here's really the way I look at it. So any given financial market is a closed system. And every closed system, according to the law of thermodynamics, always moves to a state of maximal randomness unless something is applied. And you can kind of liken it to what happened. I mean, in a way, you know, if you have kids, your kid's room is a closed system. And it always has this trend to go to a state of maximal randomness. There are clothes all over the floor, the bed's unmade, there are empty water bottles all over the place. The only thing that creates order from chaos is the application of energy. Now, in the market, the only thing that creates a trending market or order from chop, which is chaos, is the application of large amounts of money. Unless money is applied in a specific direction, the market as a closed system will always desire to move in a random way and ultimately desire to move in a state of maximal chaos or complete chop. So the application of institutional money is what creates a trend. There is no other way to bring order from this chaos without the application of large sums of money. You and I, as commercial traders, don't have enough energy to bring the market into a multi-time frame alignment. And when it is in a multi-time frame alignment, that's when the big institutions are bringing their money to bear, and they're creating a real state of order. Now, the first indicator that we use, now the first thing that's important to know is that no indicator that we use to give us any signal that we take ever is governed by the price or the movement of price on our trading chart. If we use this to create the indicator signal, it simply has no ability to look into the future. Now, we've already looked at this on the oscillator and the MACD and on Fibonacci. These indicators have no predictive value. They will not increase the precision of your trades. They will not give you more winning entries because they don't look into the future. They only tell you what's happened in the past. And people are always complaining about forward-looking indicators. And the fact is that any indicator that uses the data, price, movement, and trend from your chart that you trade, it cannot look into the future and provide you with a prediction of whether price is going to go up or go down. So the first indicator that we rely on heavily is called bias. Now, bias assesses the direction of the market on the two higher time frames. It doesn't care what price is doing on your trading chart. Now, this is a 5 range of crude. Normally, we trade crude on an 8 range, but it doesn't make any difference. Now, if you're trading a range chart, we use the 2 higher fib numbers as the 2 higher time frames. So if you put a 5 range in, the bias indicator will automatically default to an 8 range and a 13 range as your two higher time frames, and that's what it's going to look at to assess this background bias. Now, when the background bias goes pink, it means these two higher time frames, the 8 and the 13, are trending to the downside. Now, what does that mean exactly? And I'm going to show you later on the charts. It means that the 50 is moving down and is red. We have a proprietary 15-period moving average is down and it's red. It means that price is below the 50 and the 15, so that it's broken all resistance to the downside, and it's done so on the two higher time frames. So it has tremendous predictive value, because when your two higher time frames are aligned and moving to the downside, price on your trading chart is very likely to move in the direction of your two higher time frames. So the fact that the background bias is pink is the reason price is falling here. The falling price doesn't turn the background bias pink. And that's really the key to why this indicator is a true independent variable. It doesn't care what price is doing on your trading chart. It only cares what price is doing on your higher time frames. And in so doing, that assessment predicts that price on your trading chart is going to follow your two higher time frames. Now, this is the strongest down bias because price on these two higher time frames has broken all support and is heading down. And the 15 and the 50 are both red and also moving down. Now, we have weaker background bias signals, but with the transition zone trade, we're only interested in the strongest down color and the strongest up color. And you're going to see more of that. Now, the other independent variable that we look at is true money flow into correlative markets. Now, that's what the quant analysis indicator does. And there's a unique quant analysis indicator for every single market because every single market has different correlative markets. And to give you an example, the markets, there are 3 markets in each line. So there are 6 correlative markets on bonds. There are certain markets that move up when bonds move up. And they must move up with a correlation coefficient of 0.7 or greater. So every time bonds moves up, these markets must also move up 70% of the time or greater. When bonds move up, there's certain markets that move down, and they must move down with a correlation coefficient of 70% or greater. So they actually, in effect, track money flow. And what happens when both of these quant lines, the reason we call them quant lines is because each market, based on its correlation coefficient, is quantitatively weighted. If the correlation coefficient is 0.9, as it is between bonds and notes, then notes, treasury notes, is heavily weighted in these lines. If the correlation coefficient is weaker, then it's quantitatively weighted in a weaker way. So I just wanted you to know how we got the name for it. But what this is telling you is, now bonds are going up. The rise in bond prices is not because the lines are green. I'm sorry, let me rephrase that. The move up in price doesn't turn the lines green. The lines are green, and that tells you that money is flowing into the correlative markets that move up when bonds move up, and the correlative and money is flowing out of the correlative markets that move down when bonds go up. So it really is tracking money flow. And what these dual lines are telling you is that money is being pumped into bonds, all the correlative markets associated with bonds, and it's being pulled out of the correlative markets that should go down when bonds go up. And all this is a reflection of the sector rotation of money that institutions do throughout the day. When risk is on, they're going to put their money into the most riskiest investments, like stocks. When risk is off, they're going to put their money, they're going to rotate their money out, and then they're going to safer investments like bonds, like notes, precious metals. There's a correlation with certain currencies. So there's going to be a flight from stocks into safer investments. So it really, really does track money flow. And you're going to see on a live chart, or the chart from today, that when our correlative market lines are dual green, the price of bonds is very likely to rise. When it's red, green, you just can't tell. And you see when it's yellow, yellow, and the institutions are not pumping money into the markets that correlate either positively or negatively, then bonds breaks down into chop. And again, I don't want to bowl you over with numbers, but the sensitivity over specificity times prevalence equals the positive predictive value of a trade, i.e. it equals the likelihood of you're getting a winner, and prevalence, in this case in the market, can be substituted for trend. So you have got to know when the market is trending, because the prevalence of getting a successful trade is high. When the market is choppy, the prevalence of getting a successful trade is much lower. Even though the sensitivity and specificity of the signal hasn't changed, you still have to multiply that ratio by prevalence. And so you only want to trade a trending market. And when you can track money flow, institutional money flow, you really have a leg up on seeing where that money is being rotated. So now these are the other two indicators that we look at. We look at our 50 period. This is just a SMA, a simple moving average. And we look at our proprietary 15 period moving average. If you put the SMA and the EMA, the exponent, I put it as an exponential, but it really is not. If you put the 15 exponential over it, it's going to crisscross it like this. If you put the simple over it, it's also going to crisscross it like that. It really calculates trend in a different way. And this is really just for reading market structure and price action, which really is not relevant to what we're doing right now. But on the short trades, we want the 50 and the 15 to be heading down. Long, we want the 50 and the 15 to be heading up. The algorithmic entry, the automatic entry, will allow the 50 to be yellow. But it must have a red 15 on a short, it must have a green 15 on a long, and the color of the 50 can be yellow or red to the short side, yellow or green to the upside. Now we have a lot of specifics for the trade, and I may want to review this slide with you afterwards to give you a really good feel for when there's an entry. Now we have both a discretionary entry that I call in the trading room, or we have an electronic algorithmic entry that's a system-generated signal that's automatically taken and sent into your computer. Now we look for the transition zone. Now when we first get that green color and we first get that dark pink color and all the time frames come into alignment, there is the first clear-cut indication that institutions are creating order, because we have 3 time frames in alignment. Now, if your trading chart is not set up for a trade, if the background bias goes pink and the 50 and the 15 are not heading down, you don't have a trade. If it goes green and the 50 and the 15 are not heading up, you don't have a long trade. So everything has to align, and the quant line has to align to indicate that money flow is moving in the right direction. Because listen, even in a system in which there's maximum, or that is moving towards maximum chaos, there's always the random chance that things will align by accident. But the more independent variables that are required to come into place for the trade to occur, the less likelihood that it's a chance random event, and the greater likelihood that this is a real signal and it's going to really roll. Now, after the transition zone occurs, we look for the first retracement after the entry. On two contracts on crude, our first target is 7 and our stop is 7 ticks. Ours minus 10. When we get to 7, we lock in $70. But we're still at risk for 30. So once we get to 7 ticks, the most we can lose on the trade is $30. So I put that here. First target hit 70, stop at 10, risk $30. When the price hits 10 ticks, the stop goes to minus 5. You're up 70, and your maximum loss, maximum gain, your minimum gain is $20, and you cannot lose money. And from then on, the trade is going to trail by 15 ticks. So it's a very simple ATM that we program into your trader. Now, before I move forward, let me just see. Now, I wanted to show you 15-tick trailing stop. Now, you can close the trade when, well, the trade will close automatically when the 15-tick trailing stop is hit. The trade will close automatically on the electronic entry when upside resistance or downside support is hit, and will close when the modified 15 turns yellow. Now, you don't have to worry about any of this, because if you sign up for the system, we're going to do a couple of webinars. I'm going to go into in-depth on how to see these signals, and they're really easy to see. But what I wanted to do was show you a really nice trade that we got on crude on 8/12. Now, we hadn't yet rolled out the system, but we were beta testing it. Now, here is the most powerful entry that I've seen, and that is when a pullback candle on your trading chart rotates the background bias to green. That's telling you that price is pulling back on your trading chart, but your higher time frames continue to move to the upside. This dark green tells you that the 50 and the 15 are heading up. The 50 must be yellow or green. The 15 has to be green. And this is on an 8 range. It's got to be on the 13 range and the 21 range. And all resistance to the upside is broken. So you've got nothing holding this trade back from moving to the upside. And when this happens on a pullback on your trading chart, you're in at the close, because this is a perfect entry when the transition zone actually is the entry. It doesn't have to be, but these seem to occur fairly commonly, and they are the most powerful entries. Now, on a 15-tick trailer, you go all the way to 61 ticks. Then you're going to take your 15-tick stop. If you haven't closed it already, now everybody can, even if you're on an electronic entry, you can intercede on the trade at any point, override the system. If you're up 50 ticks and you're on a 15-tick trailer, you've got to get to 65 to make more money. So you're going to take your $570 and close the trade. And that's what I would have done on this trade. I simply would have closed it, but we let all of these close electronically. And on this trade, it took a 15-tick pullback. So you lost, what you did is you went from 61 to 46 ticks. So you made $460 on the runner, and you locked in 7 on the first target. That's a $530 trade on 2 contracts. That is your perfect transition zone trade. And I'm telling you, they occur fairly often. Now, the more the market trends, the more often we get them. In the summer months, we maybe see 2 to 3 a week on crude. As we move into the fall, I'm going to show you how the market trades when we get better volume and everyone's back from vacation. We're going to see these trades occur often. And you'll also see that the quant line here is green. So money flow is just coming into crude. It aligns the higher time frames. A pullback on your trading chart sets you up for a tremendous move to the upside. Now, the maximum amount of money you can win, there is no maximal amount. The maximum you can lose on a trade is going to be about $150 to $160 because you're not going to take a 10-tick stop. You're going to trade out on a reversal candle. So if the next candle after your entry moves to the downside and closes to the downside, that's your exit. You don't take the full 10 ticks of risk. If it goes 5 ticks in your favor and then comes back, you're only going to take a 5-tick stop. You're only going to lose $100. That's why the average loss on these trades is only $110. There's a lot of momentum to the upside to carry these trades, and very few of these trades don't make it to 7. And once they get to 7, your maximum potential loss is $30. And once they get to 10, you must make 20 bucks. So if you make 20 bucks on a trade, it covers your commissions, and you can have dinner at McDonald's. So that's not such a bad trade. And so what we're going to do now is I'm going to go to the charts, because I can talk about it all the time, forever. But let's take a look at the trades on the charts. Now, what you should be seeing now are the actual charts. Now, let's take a look at crude. Now, we want to look at the transition zone. And let's take a look. Let's go back. Well, let's go back a few days. Now, remember, I'm looking at crude during the summer months when it's trading as poorly as it can, and you're going to see some unbelievable trades. The thing is, it's very difficult to find a loser. Now, the one thing that I want to point out is that these are all fractal indicators, and these assimilate data from multiple time frames, as I had mentioned. Now, the basic logic of the NinjaTrader code changes a fractal indicator when you open and close it. When it's trading live, what it does is it compares the candle that's forming with the previous candle. When you close and reopen the trade, it then assesses the candle that you're looking at with the next candle. So what it does is it pushes everything back a candle from where it occurred in a live chart. Because it switches, this is the critical candle. And now it's looking at the future candle. On a live chart, there is no future candle. It compares it with the previous candle. So we have to give it a one candle a leeway. So let's take a look at the first transition zone. Now you see here, there's a pullback into the zone. There's no retracement, and there's no trade here. And you'll also notice that the move down occurs on a green 15 and a yellow modified 15. There's just no trade on that transition zone. Now what we need is a move through the zone and a quick pullback. What time is this here? Now, here's a trade, except the zone is one candle to the left. So you've got a retracement, and the zone is here. And you're going to take this trade, Now this is 12 in the afternoon, and this trade goes 7 ticks. So on this trade, you're going to lose 30 bucks. Now here, one of the other parameters is the space between the 15 and the 50, optimally, should be about 10 ticks. Here, it's 14. But if you took the trade anyway, and this is what we have on the algorithmic. The algorithmic has the power to extend the MA diff. If you took the trade here, it's going to go all the way to here. You're going to make 18 ticks because it never stops out. That's the power of the retracement. But you want the retracement to come quick. Remember, this is where the zone starts. This is 1 candle, 2 candles, 3 candles, 4 candles, 5 candles, 6 candles, 7. That's a lot of candles. You really want 5 or less. But if you give it a lot of leeway, you make 18 ticks, and that's going to give you 7 and 3. It's going to give you $100. And the space is too wide. And I would like to tell you that this is a winner, but it's not. I want to show you the conservative trades on a transition zone. You can see this transition zone isn't even here, and the MA diff is 19. And let me reset the chart. Okay, the color's right. So in a fractal indicator, you got to constantly reload the chart. And you know what? It doesn't do it if we go forward and we move backwards. So let's do that. Then I don't have to constantly refresh. Now I'll show you the trade we got today. Here it is, and here's your perfect. You get. No, I'm sorry, it's not here. It's right here. And here's the quick retracement. Now the algorithmic system took it. Even though the MA diff was wide, was 16. You can see it never stops the trade out. It's got to come back 15 ticks, and it never does. Now the magic number, for some reason, is 15. That's how we set it. This came back 13, and what you did was, here's your entry, and you got this whole trade, I believe, down to here. And that is, I can't remember exactly, but you got 37 ticks. Then it's going to come back 15. There's no reason to take it out. So you're going to lose 15 ticks. You're going to get 22 ticks on the runner, and 7. You're going to get 29 ticks for a $290 trade. Now let's move this way. There's no transition zone here. And remember, it's got to occur quick. Here's 1, 2, 3, 4, 5. And the other thing is we do not trade into an unbroken pivot. So the transition zone algorithmic will not do that. Now here is the best trade, like I said, that you can get. You have the move down, it retraces, and it creates the transition zone starts. And remember, the transition zone is really starting on this candle. The quant line is really one candle over here because it's been pushed to the right. And your entry is here. Now, this is your entry. This is back 16. So there's your stop out. So the trade is going to go actually here, which is 38. And then it's going to come back 15. And so it's going to give you, unless you take it out on your own at 30 or 35, there's no way to know. And we just take our equity from the 38 and subtract 15. So you're going to get 23. and you're going to get 7 on the first target. That's a $300 trade on 2 contracts. Now, this is a yellow 15. There's no trade. And then we move too far into the zone to take a trade. And again, we're on that pivot. Now here's the zone. Here's the trade we got today. Right here. Right on the transition zone here, we get a pullback. We're in here. Now, remember, the system will take it out when the modified 15 turns yellow. So the close of the candle here gives you 40 ticks. That's 40 ticks from here to here at the actual exit, plus 7 on the first candle, on the first contract, gives you a $470 trade. Now, there's no early retracement here. This is your optimal entry. It comes up. And here, and the diff is 16. Now, this is a trade to the downside. It's 1, 2, 3, 4. It's the 5th candle. It's going to go 7, and you're going to lose $30. And here's your trade, right here. Remember that the zone pulls over. The MA diff is really tiny. Oh, actually, this is across a day. Here's your beautiful trade, right here. Here's the zone. 1, 2, 3, 4, 5. One more. And up you go. MA diff is small. That's the space between the 15 and the 50. This would be an algorithmic entry, automatic. It's going to go all the way up to here. It's going to go 58 ticks. It takes you out on a 15-tick stop, which it would, unless you close it on your own. You're going to lose on the trade. It's going to give you 43 ticks plus the 7. That's a $500 trade. That's the power of the pullback when your higher time frames are still moving to the upside, and they just moved into alignment here, and money is coming into crude oil. Now you can take this retracement. It's a little bit far off the 15. It's quick into the transition zone. And I think the algorithmic would take it. And this one's going to go 13, so you're going to make $30. You're going to make $20. You can see that the losers are tiny. And here's another great entry. Price retraces at the zone. Right here. Now you're way off support, but on these trades, you can give this a lot of leeway. And price goes all the way up 29 ticks. If you let it run all the way, you subtract 15 again, you're going to make 15 and 7. That's a $220 trade. Now there's nothing here to trade. Now this is a little bit riskier because the 15 and the 50 are a little bit wide. Let me see how wide they are. It's 21. I would not take that on a 21 MA diff. It's a little bit too wide. Even though it's a nice winner, and you could take it if you want to stretch, and it's real close to the zone here, it's just a little bit too overbought. Here's your trade. Now the problem with the short is we don't trade into an unbroken pivot. This pivot is not broken, so we don't have a trade. It works, but on the right edge we would stand aside. So we don't, it moves down and then it moves up. We'd have no trade here. Here's a trade. Now it's 1, 2, 3, 4, and this is the 5th candle. Here's your entry. This is not a big winner, but the key is you don't get a loser. This goes 11. So you're going to make $20 on the trade. That's your McDonald's. Now here's your entry. Remember, it moves over 1. It goes 11. You're like piling up the Big Macs here. Because here's what you're waiting for. Here's the move. The retracement into, as price goes up on your trading chart, the movement of the higher time frames to the downside continues. So you're retracing into higher time frame movement to the downside. Those are the trades. Now you've made a few McDonald's meals, and you've taken a couple of $30 losers, and then you get these enormous winners. Now this one's 34. Subtract 15 if you take it all the way to the bottom. So you're going to wind up with 19, and you're going to wind up with 7. That's $260. On one trade, you make up 8 losers. Nothing here. This is way too high up. But you see how powerful this is if you're just taking a trend trade. The move up, the retracement, and the continuation. It's not a transition zone trade. It's just a regular continuation trade. Here's the move to the downside. The transition zone turns red on a pullback. On this trade, you're going to get 15. Now, you're going to run on this trade at 10, so you're going to get 5, and you're going to get 7. So you're going to get $120 there. Now, remember, I'm not looking at the time. So some of these transitions are occurring in the middle of the night when volume is really lousy and there's not much follow-through. So, but I'm just doing this completely apart from looking at volume and time of day. Now, the zone turns here. Let's see, we have 1, 2, 3, 4, 5. This is the 6th candle. You can take a 6th candle, and this trade never comes close to stopping out. Your entry is here. It goes 81 ticks on this entry. And in fact, it starts at 14:28 Eastern, and you're not out of the trade. Hopefully you can stay in it. It continues down until 22:54. So it's a very, very late trade. But it does not stop, even though probably the movement down slows. Now, if you look to the upside, now that's a red 15. So you're going to take the full 15 tick pullback on that. So that's going to be a 66 tick run to the downside, plus 7 is 73. $730 on this entry. On the quick retracement, 1, 2, 3, 4, 5, 6 candles, and down. That's the power of institutional money creating multi-time frame alignment along with the quant line telling you that money flow is pouring out of crude. Now, if you didn't take the quant, if you didn't take the transition zone, you could simply take this trade. This is a standard trade out of consolidation, and we take them all the time. This is going to be with 4 contracts, and it's a much tighter stop. And you're only going to go to here, and you're risking 4 contracts on a 10-tick stop. So your risk to reward here is not as beneficial as it is on a transition zone, where you're looking to get a 60-some-odd tick trade. Now you can re-enter here, and you're getting a very nice move to the downside. And you can re-enter here, except you're getting, the MA diff is getting big, and you're getting oversold, and go down again. But your best risk to reward comes off 2 contracts, getting in off the transition zone pullback. Now the transition zone pullback you could call here too as well, now that I look at it. Your entry is going to be 1 tick better, but the problem here is you've got the pivot. You've got to wait for the pivot to break, and it breaks on this candle. And this gives you the freedom to take the trade. And you don't want to trade into unbroken pivots. When we looked at that, that caused problems. Now let me show you some on the E-mini. Now on the E-mini, I wanted to take a market that was, the E-mini in the summer is very, very tough to trade. And we're moving now into the fall when we're going to get much more volume in a much better trending market. And I just wanted to show you. Now we're just going to move. We'll move backwards from here, so we don't have to recalibrate the chart. Here's the zone. Get our first pullback. Here we have 3 quant lines, 9 correlative markets, not 3 on 1 line. We have 9 on 3, and here's the retracement. And that is a 5.25 point trade. Now the E-mini is going to go online right after Labor Day. Because right now the only thing that we've already done the 2 years of market replay. What we have to do is just fine-tune the ATM. We're not exactly certain how far to let this trade come back before it stops out. The 15 ticks on crude is perfect. And in fact, we get so many that pull back 13 and 14 and then continue to run to the downside. The 15 is really optimal. We want to create that same pullback value here. We're close to it, and we'll have that. Now you see right here, you don't have 3 quant lines. You can't take this trade unless all 3 quants are green. That's going to hold you up on a lot of trades, but it's going to prevent you from taking a lot of losers. Right here, can't take that trade. The 15 has to be above the 50. See this move up? There's no retracement anyway. There is no transition zone. This is a nice transition zone, but you don't have the quants. You have much more specificity here. Here's a nice trade, but it's not a transition zone trade. Now, right here is a transition zone trade. You got to pull the quants over to the left 1. And if you do, you've got 3 greens. Whoops. And here's an entry. That's 1 3/4 points. Now, we're way deep in the transition zone. Here's a transition zone with no pullback. And you see, I haven't cherry-picked these times. If I just wanted to show you perfect trades over and over again, I could. See where price is on this transition zone, 5 miles up. Now here's your trade. Let's see. Nope, you don't have that middle quant. You can't take it. Here's a gorgeous trade. The problem is you don't have any pullback when you have background bias and all 3 quants are red. You need a retracement. And here the MA diff is way too big. The space between this is a market, it's too oversold to take a trade to the downside. Now, the fact that you have the specificity, which means everything has to correlate in order to take a trade, is going to keep you out of some winners, but it's really going to prevent you from taking losers. And that's the bottom line for day trading for profit. And it's trading with specificity. If you try to trade with sensitivity, only have 1 or 2 parameters, 1 or 2 independent variables that you need to align to take a trade, you're going to wind up getting more winners, but you're going to really suck in the losers. And when you suck in losers, the market's going to kill you. So we want to be very specific with our entries. Now, here's a trade. We have to pull the background bias to the left, and it's real that this happens, believe me. Because what happens is when I close the charts in the afternoon and I open them at night, everything shifts to the right. And I've called NinjaTrader and talked to them. And when you have a fractal indicator, that's the problem with it. Everything's going to get shifted. Now, you know what? The bottom quant isn't going to shift enough. So you have no trade. This one's occurring. You don't have the quants. This one's a great trade, but it's into an unbroken pivot. And here we go, right here. First trade, transition zone. It's a pullback. And these are worth waiting for, because when you get them, they work. That's 4 3/4 points. And this one just misses. No pullback, no pullback. Pullback is too late. Because I don't want to. Let me answer questions, because I think you understand the trade. Now, the one thing that you have not seen, and I'm telling you, I haven't cherry-picked these charts, is a full loser. The worst we have come up with are a couple of $30 losers, and we've seen 4, $5, and $600 winners. So the risk to reward here is amazingly high. Now, you have 2 ways you can take these trades. We have an algorithmic entry, which will do them for you electronically and manage the trade for you. Now, there's one, I don't want to also get too complicated because I don't want to bore people. But here's the problem when you trade. I think that in the next 5+ years, I don't know if human beings will be trading anymore. And here's the reason. An algorithmic system, each of the independent variables that we have in a trade, in each specific trade are related nonlinearly. Now, we know that the space between the 15, we call it the MA diff. We know that we need bias. We know that we need the quant. Now, those are just 3 of the independent variables. We need a quick retracement. Now, are all of these independent variables weighted equally? Well, the answer to the question is they never are weighted equally. And on each entry, they're rated differentially. And so what it means is they're related nonlinearly. In some cases, the MA diff is very important. In other cases, it's not very important. In terms, it's still an independent variable, so it's still associated with risk. Always. But when is it very associated with risk, and when is it only moderately associated with risk? When is the quant the most important independent variable? When is that quick retracement the most important independent variable? That's what an algorithm can assess that we can't. When it feels that the strength of the trend is strong, it will space out the MA diff and allow you to take a trade, and it'll take it electronically. That's why algorithmic systems are so robust, because they look at independent variables that are never related linearly. And that's why most of the software out there doesn't work. They don't understand the sensitivity, specificity, and positive predictive value of a trading entry when we do. So you can take it with the algorithmic system, or you can trust me to take the trade. And you're going to be in the trading room, and I'm going to call them. And that's called discretionary trading. I hope I spelled it right. One of the two. So that's really the system. It is very specific, and we're going to be moving it in the not too distant future to the NASDAQ and gold. We're going to add these on. So let me just finish the slides, and then I'll go to all the questions. Let me come down here. Now, the exit criteria are fixed. When you hit that 15-tick trailing stop, you're out. If you hit upside or downside resistance or support, a pivot, you're out. The algorithmic is going to take you out. I'm going to take you out. Modified 15 turns yellow on a candle, we're out of the trade. The entry criteria have a little bit of play because of the non-linearly related independent variables required to get into a trade. And if I told you that the entry criteria were absolutely fixed and you had no discretion on taking the trade, I wouldn't be giving you an accurate assessment. That's why the algorithmic system has play, and that's why we have play. We have to try to make an assessment of the strength of the trend. And we know from the setup that if the retracement comes on the first color change, when we get green or dark pink, and we get that immediate retracement, we know that is the strongest entry that we can get. And if the MA diff is 14 ticks or 15 ticks, we're going to take a risk, because all we need to do is get to 7, and our maximum loss on the trade is $30. It's worth the risk, because if the trade runs, we can easily make 200 or 300. And if we get to 10, we're guaranteed our Big Mac. And an enormously high percentage of these trades go 10 if you take a retracement, which is a must on the trade. Now, here's the cost. We did this once before. I mean, we're very, very successful. We're going to do it again. It's normally $14.99, and we're going to offer it for $7.98. That's the discretionary system. The $16.99, which is normally $3,400, we're going to offer for $16.99. It's got an automated entry. You don't have to do anything. The trade is all automatically managed by the system, and it's got a very fixed set of exit criteria. So your exit is going to be the same exit that we would take in the room if we got into the trade. Now, everyone who purchases, we're gonna have a webinar, and we're gonna trade a live market, and we're gonna look for transition zones. Now, the problem with doing that is we could sit in the market for 3 hours and not get one, and sit in another 3-hour session and we could get 3. It's very hit and miss. But what I'll probably do is I'll do it on market replay data. So I know that the trades are coming, and I'm going to leave it up to you to determine whether or not you'll take the entry. It's sort of going to be a quiz, and you will see how easy it is to pick these up. Now, the transition zone has an automated alert, so you can listen to it beep when that transition zone occurs. Now, for the first 5 who purchase, you get 6 months free in the live trading room. You get 6 months of the NTD trade execution platform, which is really helpful. That's our buy on an up close, sell on a down close. It's got a patent pending. Every week I hold a didactic training session at 1 o'clock, and I'll tell you, these sessions are worth the price of admission because I teach you how to reprice action and market structure, and they're very, very helpful. Now, also the first 5 will get all new markets as they are added. Very soon after Labor Day, we're going to be on the ES. And then maybe a week to 10 days later, we're going to be on gold and the NQ. Now, if you're not one of the first 5, you're going to have to buy market by market, because each one of these is going to create a really superior equity curve. And the offer is good through Friday. And after that, we're going to 3,400, we're going to 1,499, and we're not going to offer that again. And I promise you that. Now, let me get to questions. Here's our number, 855-765-6681 at RightLineTrading.com, info at RightLineTrading.com. And I'm telling you, what I showed you is real. It takes place in real time. An early retracement in a transition zone is going to give you a really nice runner. And this isn't a black box system. It isn't magic. When the quant line is in your direction, or quant lines, depending on the market, and you know that money is flowing in the appropriate direction, and that money aligns the market such that your 2 higher time frames are moving in the direction you want, and your trading chart gives you an early pullback into a really strong trend on 2 higher time frames, you're going to get a ride on that trade. And you can see, not only is it right mathematically and algorithmically, you can see just intuitively that is the time that you want to get a trade. And it's very tough to see if you're looking at 3 time frames. But on our charts, it's super easy to see. Now let me take a look at the questions. Just tell you what I'll answer, because I'll answer them all. Lag, Armand, there's no lag on these indicators. None. I mean, they're tracing out exactly as you see. I mean, that transition, now everything forms intra-candle, Armand. So you're going to get the alert to take a long trade or a short trade on a pullback on a transition zone, because the transition zone flickers and triggers an alert intra-candle. You want to take every trade on candle close, and you're already going to be in the trade. I can't bring up an NTD for you. Let me see if I can really quickly. Hold on one second. But the NTD makes it real simple. Let me see if I can. I can't. Hold on, I can. Hold on one second. I'll just show you the NTD really quickly. Let me enable it. We'll see how easy it is. Okay, it's not letting me for some reason. I don't know why. I can't do it. I'm sorry. Yeah, Chris. If you're coming up to a pivot, if you break the pivot quick and get a quick retracement, you work around the pivot, but don't trade into a pivot. Because what we did was we looked at the equity curve that was generated by trading into pivots and by not trading into pivots, the equity curve is better if you respect the pivots. So don't trade into them. Now, the algorithmic system will never trade into an unbroken pivot. But when we take a discretionary trade in the room, we may just try to break a pivot. I mean, we'll see. I mean, I know the setups and the market structure that are strongest. But in general rules, we don't trade into unbroken pivots. John, if you're up 25 ticks or you're up 15 ticks, the important thing, because John asked about overnight, these trades almost always make money for you. And if you're in a trade and you got to close out for the night, just close the trade out. Close it out on your own, say a minute to 4 or 2 minutes to 4. Take your profit and walk. I mean, that's the best thing I think. I wouldn't hold these overnight. I mean, unless you have a huge margin account and you really, really have a penchant for risk, if something really bad happens in the night, it can change the whole direction of crude in the morning. As long as you're up money, I would close the trade and don't let your broker close your trade because he's going to give you a horrible fill. You can't, John. When you trade in real time, there is no displacement on the indicators. It's only when you close the platform and reopen it. So let's say you want to do a 200-day look back and you want to take an assessment of where the trades are. That's when in your own head you've got to take all the indicators and push them to the left by one candle. As long as you haven't closed and your Ninja Trader, anything that's been traced out live that day is accurate. As soon as you close and open, everything will shift one candle to the right. Sal, we're looking at that. We're looking, again, between 7 and 10. Even though it's a 5 range, we have 3 quant lines. That's 9 correlative markets. And we don't see that kind of alignment very often. So when we get that 9 market alignment, and we have money flowing so strongly into the E-mini, we'll take a little bit more of an overbought or oversold signal. So we're going to let the MA diff widen. We haven't determined exactly what it is, but that's what we're going to work on actually during the Labor Day vacation, and we'll have that. We'll have the ATM and all the parameters out right after that. Okay, Ken, here's the trade today on the E-mini. If I can find for some reason my chart's locked. Let me find out why. Oh, here it is. Okay, hold on a second. Okay, now they're unlocked here. No, I lost my questions. Okay, I'm going to get to all the questions. Somehow they've... Okay. No, I actually loaded 200 days of data just to... It was right here. Here's the zone. Right here. And you need the 15 to turn red. We have 1 candle, 2, 3, 4, and if you go down right here, you just got to pull this over because I've closed and reopened. This is a triple quant. This is a triple red. And this right here gives you a short trade. Whoops. Now, the algorithmic got the trade and it went all the way to here. Went 4.25. Now, we're just tracking it ourselves. We don't have it out. But that was a short. And that was the only one of the day. After that, the market just faded out. And we had that one on crude. But it's not bad to make 4.25 points. I don't know exactly what the trailing stop is either. I want to be honest with you. But here's the crude trade. And that went 37 ticks, minus the 15. So that was a 22-tick trade plus 7, 29. That was $290 on a lot of candles, sideways and then down. It works on NinjaTrader. Now, average number of trades per day is going to be right after Labor Day. We're going to see three. I believe you're going to see 2 to 3 trades a day. Sometimes more. When you get a trending market, you can see a trade or 2 on crude, and you're going to get a trade on the E-mini. So you're going to get about 2 or 3 trades a day. If you do get them, you're going to make a lot of money. And what we did was we smoothed the data over 2 years, including the summer. So I believe that the actual equity curve and the actual positive predictive value of an entry is higher than what we got because we included the summer months of 2 years. And it's much tougher to get an entry on the summer. The summer's much choppier. But if we look at, and we didn't exclude the summer, but if we just do September, October, November, December, January, February, March, April, and chopped out those slower months when everyone's on vacation, you're going to get a much better trending market. And let me tell you, all you need is one really nice trade, and you can make a lot of money with very minimal risk. Remember, the retracement's going to get you that 7 and lock you in, and the worst you can do is lose 30 bucks. And one trade can take you a 40 or 50 ticks, as long as you have the patience to let it evolve and not yank it out at 20 or 25. Let it go. That's my problem. You know, I see all that money on the dome, and I want to close the trade. But these trades, you really have to let go. You do. You have to have data feeds for the 9 markets if you want to trade the E-mini. If you want to trade gold and you want to trade the NASDAQ, you have to have the data feeds. We can tell you what data feeds those are. The data feed for crude and gold is very, very easy. The data feeds for the index equities is more complicated because you need 9 markets here, and you need to have the data feeds on all 9. That's a very, very good question, by the way. Yeah, write an oil report. The auto trader today did wonderful. The auto trader today, actually, the auto trader is out trading me. I have to listen. I'm not gonna, because it's today the speed of the auto gave it 2 really nice wins, and I have to find them, and I'll show them to you. I took a trade right here. Well, where did it take it? Yep. I took a trade here. And this is only 10:31. It was too fast for me because of the crude inventory. And I took a trade here. Now here, the trade went 12, but it got stuttered out of the trade. Oh, here's where it went in. It went in here. Because this one went 12, and this one was a first target only. This one went 8. We got 8 and 12 on the algorithmic, and this made 260, and this one made 50. So it made $310 on these 2 trades, and this was just too fast for me to trade. I mean, it was blowing through here, and the algo was in it and out of it like a snap. So I missed them. but I did have a really nice winner. Where was it here? Oh, right here. This was a roll back into the trend. This was an engulfing candle. You can see the background bias. You see the quants pulling money out of the market. I took the roll. We were in one tick below, and the trade, I think, went 11 ticks. That was the winner I had on crude, and I think I didn't get another one because then crude just took a nosedive. I didn't get those early algo trades, and then I just couldn't get back in. There was nothing I could do to get in. And so that's how crude went today. So listen, everyone, that's the system. It has many, many advantages. The most important is it's trading in the direction of institutional money. It's trading in the direction of the trend created by the institutional money. It's trading with money flow. And it's taking a conservative pullback. We don't chase a trade. If a trade breaks on a transition zone and we don't get an early pullback, we can't take the trade. And that's just the way it is. We need a very, very early retracement. And those are what make the trade safe. And it's very, very, very hard to find a loser. Very difficult. And these trades that initiate at the transition zone on a pullback are usually very big winners. So you can make an assessment in a way of how much money you could potentially make. The tighter the MA diff is, and when you get it on a pullback on the first down, and on the first creation of that transition, when all the higher time frames align, you're going to get a runner. So that's it. If you're interested, give us a call. It's a very, very conservative system, and I know that it will make you really nice money. So everyone, thank you so much for coming into the room. I really appreciate it. No matter what you do, I wish you the best of luck and hope you're going to make really good money no matter what you do. If you take this trade configuration, I have not seen one that has a better risk to reward, where the risk is so small and the reward is so large. And that's what you want to create as a day trader. You want to create a low risk, high potential reward trade. And this is it. So have a great evening. If you have any other questions, you can send us an email or give us a call. We'll be here for a while. And again, I wish everyone the best of luck. And I hope to see you in the trading room, everyone. So take care. Bye-bye.